All right, let's take a look at this cons deal for Badcock. This is the transaction where franchise group, the controversial holding by B. Riley, is contributing Badcock, a rent-to-own-ish business that they own. They're going to contribute that into cons in exchange for about 50% of shares outstanding. So, con transaction. Let's see, FRG contributes Badcock in exchange for 49.9% of shares outstanding. We'll call that 24 million shares. We're just going to round off. All right, so at the time of the deal, that was about $3 a share. The stock is now $4.35. So that's, I don't know, we'll call it $100 million worth of stock. Okay, so they got 24 million shares. I didn't see an actual prospectus to or proxy to know, what the balance sheet is that's coming over from Badcock. But on the call, they did mention they're bringing over about 100 million of receivables. So until then, let's just assume that 100 million of receivables coming over from Badcock. Let's just assume that's the only asset, right? 100 million of receivables, no liabilities, 100 million of equity going from Badcock to cons. And just for simplicity's sake, I think that's the easiest way to think about it. Okay, so the big controversy is that there is this slide, this sum of the parts slide on FRG from the Riley Investor Day. And people were saying, "Oh, Bryant's valuing that business at 390 million, right? Based on 5 to 7x 2026 EBITDA." So Bryant was just trying to paint the picture of here are the assets that are on the chopping block today, valuing those on 2022, and then the rest of the businesses, Pet Supplies Plus is the actual growth, the actual growth asset in there, and American Freight and Badcock are these low-end consumer rent-to-own type businesses that benefited from the stimulus COVID environment and rolled over, and now they're flat, zero or negative earnings businesses, and there's some recovery aspect to it. So that's why he's painting this picture of 2026 numbers versus 2022 numbers. So anyway, 390 million, 5 to 7x, 65 million of 2026 EBITDA. So that's the original valuation. So parts BR valued Badcock at 390 million, right? Okay. Fiscal 26. Okay. So that's the starting point. Now people are saying, "Oh, well, they just gave it away for $100 million worth of stock, and they gave up $100 million worth of receivables, and they kicked in $100 million term loan. So now they're a lender to cons." Okay. So what's going on? My thought is that FRG Riley believe combo Badcock / Con better able to achieve that fiscal 26 valuation than standalone Badcock, right? So now they've got this platform. Cons does the ABS, asset-backed securities issuances. Badcock has this way of getting their receivables out there into the market. Now they've got a partner to help grow the company. Maybe they're better equipped to actually make that $390 million a realistic valuation. So, okay, the transaction, here it is. Let's go to, where are the slides? Okay, here's where they think they're going. They think the combo of these businesses gets them to 2 billion to 2.2 billion in revenue by 2026 and 180 to 220 million of EBITDA. 20 million EBITDA by 2026. Okay, so that's where we're at. So just hypothetically, let's just do some really easy math. Really easy. Where is this the Q? Okay, Q balance sheet has 5 million of cash, bunch of receivables that are backed by asset-backed securities. Almost all of the book value, 390 million, is tangible. Okay, debt, 670 million of long-term debt and some short-term debt, but a bunch of that sits in a separate entity with these ABS notes. Where is that? Okay, here it is. Here's our debt. Let's move this. here's our debt. So these are all in a separate VIE. So really, the true CONN holding company has this $185 million revolver and $100 million term loan, which will become the RILY entity. So let's just say they get to this 180 million of EBITDA. The low end of Brian's sum of the parts math, 5x, $900 million enterprise value by then, minus 285 million in debt, right? We'll just ignore the cash. Actually, let's just round that down to 600 million for easy math. 48 million shares, $12.50 a share for cons. I don't know that that's actually worth that. I'm just like painting a picture, right? So $12.50 a share times their 24 million shares, that's $300 million. So it's not quite there, but it's within spitting distance. And maybe that is the picture that he's trying to paint, that by doing this, they're more likely to get there. So 5x, 100 million, fiscal 26 EBITDA, plus 100 million net debt, x ABS, equals 600 million equity, 40 million shares outstanding, equals 12.50 a share, times 24 million, equals 300 million. Cool. So that's the math. Okay. Other notes. I haven't looked at cons. I know that it's a low-end consumer business, and they're getting caught up in the same thing that American Freight's caught up in, and Buddy's, and Rent-A-Center, and Aaron's, and all these companies. And FRG, Franchise Group, has this really big, basically a really big bet on the recovery of that RTO, or low-end consumer business, and maybe that'll happen. I don't know. But anyway, this is Conn's historical financials. Goes back to 2002, and just plain old GAAP net income. This is the picture, right? So more than 20 years, we've got 1, 2, 3, 4, 5, and I guess now 6 for the fiscal 24. 6 loss-making years in total across that entire period. I mean, this isn't the worst business in the world. I don't know. Maybe it is. But really, this is a company that's more often than not a profitable business. 20 years public history with 6 years net losses. Okay, so I mean, this is generally a pretty profitable company. Let's see, since 2019, 74, 56, 108, minus 3, minus 59, and it looks like this year, this is the Q, this will be 120 million, probably going to be another big loss quarter. So yeah, I mean, maybe that's a cumulative loss position over a 6-year stretch of time. Yeah, probably. So I mean, that's why the stock is trading where it is. And really, the last time they got into this stretch of I guess these weren't big losses, but post financial crisis, when the company went from profitable to not profitable. Here's price to book on an LTM basis. Here's that post financial crisis period, right? 0.2 to 0.3x book. Got there again at the COVID lows, and hey, that's where it is now, that the low-end consumer is really, really rolling over hard. So this is trading book valuation similar to post GFC and COVID lows. So that's what, 0.2, 0.3x price to book, and book is all entirely tangible assets. There really isn't any goodwill on there, and I don't think this deal will add any goodwill either. Okay, so what else do we have? Where's our cons chart? So it's interesting in that this deal was announced and really telegraphed as Badcock just taking a huge loss and giving it away, and yet the market seems to really like it. So, if book value was 390 million at the end of Q3, Maybe they pick up another 100 with the receivables that Badcock brings over, so it refills that back to 490. Tack on some losses. Will they get back to profitability next year? I don't know. I don't even know if this thing has analyst estimates. Yeah, they do. Okay. So this is 123. This is the current year. So estimates have them getting back to not net income, but positive EBITDA, I guess, probably because they're issuing more securities to get there. So, maybe another period of losses to tag onto that. So it's how long will that book value help get them to back to profitability? Value 308 million. That's what is that? Today that is $16 a share ish, right? Ish. So 390 plus 148, so call it $10 a share. But 490, let's say that these estimates are true. So they're at 120 loss so far this year. So their estimates are tacking on another 47 plus 63. So that's 110. We'll call it 115 million. So minus 115 million of losses, 375, 48 million shares outstanding post close. So 780 in book value left before they get to the end of this 2025 period, going into the fiscal 26 year. So maybe that's the starting point. Do they have enough equity to last, to put the two businesses together and really get back to profitability and hit those goals that they think they're going to hit? I don't know, but that's just a quick. I don't know. I know nothing about cons. I haven't really dug deep into it, other than thumbing through the press release and trying to triangulate what franchise group was seeing from this 390 to doing this deal, and that's some quick off the cuff math. Open to comments, open to suggestions. Those are my notes.